Hello and welcome to Why Not Mint Money. This is Neil Borate from the Mint Money team. There is an old stock market saying which goes cows for their milk, hens for their eggs, and stocks by God for their dividends. Here we ask the question, can you live off dividends for the rest of your life? Let's first look at the pros of this strategy. So, the first advantage is that dividends are a kind of automatic profit booking mechanism. You can replicate the same cash flows simply by selling stocks, but it is behaviorally a little difficult to know when to book profits. Number two, when you retire, yes, you do need regular income, but you also need your capital to keep pace with inflation. And that is best done through equity in the long term. So, money that is invested in dividend paying stocks not only gives you cash flows, but also keeps growing. Now, let's look at the downside. So, number one, dividends are not certain, they're not guaranteed. When earnings of companies fall, dividends are indeed cut. Number two, dividends are taxed at slab rate. So, if you're in the 30% tax bracket, you're going to be paying a lot more tax than if you had generated the same cash flows by selling some stocks. Why is that? Because the long term capital gains on stocks, which is what comes into play when you sell stocks after a year, is just 10%, and that too over and above rupees 1 lakh. So, two advantages, two disadvantages. But let's do a theoretical exercise. What if you had picked a dividend portfolio, 5 years ago? How would you have done? So we use the Nifty Dividend Opportunities Index as a proxy, and we checked out its returns. And those are since 2016 to 2021, those are 12% as price returns. Now, this index also has a 3% dividend yield. To put it in very simple terms, around 3% of your money has been returned to you in the form of dividends every year. This is assuming that this was the dividend yield throughout this period, which is more or less a reasonable assumption. So, to add that 3% to the 12%, you come to 15%, which is a little lower than what the Nifty gave in the same period, which was around 17.5%. Why is that? Well, dividend companies tend to be mature companies, companies that don't have too many avenues to reinvest in their own business. Many of them tend to be PSUs, many of them tend to be utilities. They are not as fast growing as the broad index, and so you lose out a little bit in terms of returns. That said, 15% is a reasonably good return. Of course, this was 1 5 year period. It might not be replicated in other periods of time when the economy and the stock market is on a downward path. But it is interesting to see how a dividend strategy has played out in the past. Um, if you had put in 1 crore into this index in 2016, you would have got around 2.8 lakhs as dividend yield in 2016, and that would have grown to 4.8 lakhs. But in the pandemic year, the dividend payout was actually cut, so it empirically bears out the possibility that dividends get cut when companies are in distress. So, how do you solve for this? What do you do when in years when dividends are cut? Well, therefore, you need to pair a dividend strategy with some kind of safe fixed income instrument, such as an FD, or a low risk instrument like a debt mutual fund. So those cash flows kick in years in which your dividend is not big enough. Um, Lastly, practically, how do you implement this strategy? There are a number of dividend yield mutual funds. Um, with these funds, you can opt for the growth option, which is more tax efficient, or you can opt for the dividend option, which unfortunately is not tax efficient. But the funds offer you a wrapper through which you can capture a portfolio of high dividend yield companies. Thank you very much for listening, and goodbye.